Before every big event, a Fed decision, a CPI print, an earnings report, SPY options quietly publish a number. It's called the expected move, and right now most traders read it completely wrong. They treat it like a forecast. It isn't. Quick note before we start, this is educational commentary, not personalized financial advice. Now let me show you what that number actually is. Here's the mechanic. Take the SPY option expiring right after your event. Find the strike closest to the current price, the at-the-money strike. Add the price of the call and the price of the put at that strike. That sum roughly is the expected move. If SPY is at 500 and the at-the-money call costs $5 and the put costs $5, the straddle is $10. The market is pricing in a move of about $10 up or down by expiration. Now the misconception. Most people hear expected move of $10 and think the market is predicting SPY lands near 490 or 510. So they place a directional bet and feel clever for using options data. But that straddle price was never a prediction of direction. It's the cost of a bet that pays either way. It's a price tag, not a prophecy. So where does the number come from? Market makers who sell you that straddle. They don't know the future either. They set the price so that, on average, across thousands of events, they don't lose. The expected move is the break-even line for the person on the other side of your trade. It's the level of volatility they're being paid to absorb. There's a subtlety worth knowing. The straddle price maps to roughly a 1 standard deviation move, meaning the market is saying there's about a 68% chance SPY finishes inside that range, and about a 32% chance it finishes outside. So the expected move is not the most likely single outcome. It's a boundary. Price stays inside it most of the time and blows through it more often than beginners expect, about 1 event in 3. Let's make it concrete. Say CPI is coming. The straddle prices a $10 move on SPY. The number drops, the market barely flinches, and SPY moves $3. Everyone who bought the straddle for the big event just lost. Not because they were wrong about direction, they didn't even bet on direction, but because they paid for $10 of movement and only got 3. You were long volatility, and volatility didn't show up. And here's the aha. Your edge in options is almost never about being right on direction. It's about disagreeing with the price. If you think the real move will be bigger than the straddle implies, you buy it. If you think the market is overpaying for fear, you sell it. The question stops being will SPY go up or down and becomes, is $10 too cheap or too expensive for what's about to happen? Now, is the market ever systematically wrong? Yes, in a specific, repeatable way. Before events, implied volatility gets bid up because everyone wants protection. That fear premium tends to be a little rich. After the event, the uncertainty resolves and implied volatility collapses, the famous IV crush. On average, over many events, the expected move slightly overstates the move that actually happens. That's why premium sellers exist. They're harvesting that overpayment. And this is where retail blows up, on average hides the tail. Sell that overpriced straddle every month and you collect small wins, small wins, small wins, and then 1 CPI or 1 Fed surprise moves SPY 3 standard deviations and hands back a year of gains in an afternoon. The market isn't wrong that the tail exists. It's wrong sometimes about the price of the tail. Those are completely different bets. So how do you read the number like a professional? Don't ask which way. Ask 3 things. 1, what move is being priced, the straddle? 2, how big was the actual move the last several times this event happened, the realized history? 3, is implied cheaper or richer than that history? When the implied move is well above what the event usually delivers, sellers are favored. When it's oddly calm before something genuinely uncertain, buyers get a bargain. Picture it, the last 6 CPI prints moved SPY about $6 on average. This month the straddle is pricing 11. That gap, priced at 11, typically delivers 6, is information. It doesn't guarantee a small move. It tells you the crowd is scared and you're being paid well to take the other side, if and only if you can survive the month it's scared for a reason. So what does a disciplined trader actually do? First, they size for the tail, not the average, position small enough that the 3 standard deviation day is survivable, because it will come. Second, they treat the expected move as a range to trade around, not a target to chase. Third, they write down the implied move and the realized move before every event and build a feel for when the price is rich. The edge isn't a secret indicator. It's the discipline to only act when price and probability disagree. And this transfers everywhere. Earnings on a single stock? Same straddle, same question. Bitcoin around a halving, oil before an OPEC meeting, a biotech before trial data. Anywhere there's an options chain, the market is quoting you a price for uncertainty, not a prophecy about it. Once you see the expected move as a price tag, you stop being the tourist who buys fear and start being the shop that decides whether fear is fairly priced. Here's the line to keep at your screen. The expected move is a price, and your job is to decide if it's the right price. If that reframed how you look at an options chain, subscribe. Paragon Signals is about signal, not hype, and we do this every week. Trade the price, not the prophecy.